right. It is 10 a.m., so I know everybody's time is valuable, and honestly, I think this is a really great strategy, so I don't want to delay any longer. Let's go ahead and get started. To anyone just joining us, hello, my name is Lynn Voss. I'm joined today by Brent DeGroot with OneAmerica. He's the individual life and financial services person specifically for the care solutions. And he and his internal sales partner, Adam, um, I believe we'll be sharing their contact information later in the presentation. Again, we invite you to call GoldenCare with any questions, but for those who need some extra detail, I'll tell you what, Brent's the guy to go to. So, um, without further ado, I will actually turn it over to him and we can start the presentation.
Thank you, Lynn.
Ah,
Let
I
me,
see the iguana.
yeah, let me make this full view and switch screens here, and then we should be able
Perfect.
to fully see. All right, excellent. Well, thank you all. Appreciate you coming out today, and Lynn, thank you for that excellent, way to introduce me. So thank you very much. I am the regional account director for OneAmerica, and I've got 6 states, and then really what I do is work from the top IMOs, BGAs, whatever they want to call themselves, on down through their hierarchies. So wherever the BGA is located, that's the folks that I work with. So Minnesota happens to be one of my states, which obviously I think most of you know that's where GoldenCare is located. And I've got 5 other states beyond that: Wisconsin, the Dakotas, Nebraska, and then I picked up Arizona last year because I needed someplace to thaw out in the wintertime. Without any further ado, I'm very excited, like Lynn is, to really bring you this opportunity. And what's crazy is that annuities and certainly the federal government has looked at this silver tsunami. If you haven't heard that, it's a little bit of a term to talk about the aging demographic of Americans, that the silver tsunami is moving closer and closer towards needing care. And I'll talk about some of that as we go forward here, but adaptable annuities and utilizing the Pension Protection Act, and I'll get more into that here in just a minute as well, is a great opportunity for you. And hopefully, if you looked at kind of some of the description, if I could tell you long-term care planning can be done with no premiums and no surprises, would that interest you? I hope that's part of the reason why you're here today. So let's get into this further a little bit, and I should probably talk about OneAmerica just for a certain period of time here. Now, this commitment under the first kind of subsection, if you will, we are an asset-based market leader. We were one of the first to come out with these types of solutions. There was us and another carrier that we've been doing this now for 37 years. I know that says 35 years of leadership, but it's now our 37th year of doing these asset-based type solutions. And so very happy to, have a long-standing relationship and understanding of this marketplace. 37 years says, look, we were designing plans, administering plans, filing them, and most importantly, paying claims. And I'll get to that a little bit more in the people section of this portion. But we, so 37 years in the asset-based long-term care planning space, but we can trace our roots as a insurance company all the way back to 1877. So a long-standing history of OneAmerica in the insurance marketplace. We are a mutual holding company. I think most of those that are out there today doing any kind of type of LTC services certainly are mutual companies. I can't say all, but most are, and there's some reasons for that. And then you can see our financial strength. 95 Comdex, A+ rated from AM Best. So the most widely used indice out there. And then you can see our AA- from S&P Global Ratings as well. So a very financially sound company. Now, flexibility. I like to talk about this because we're the only asset-based leader today, asset-based carrier today that has both whole life and annuity-based systems. So kind of chassis, if you will. Now today we're only focusing on our annuity base because there's some great opportunities here that I want to talk to you about. We are the only asset-based carrier that offers lifetime protection. So by adding a continuation of benefits rider with some of our solutions, you can cover one or two people in a policy for up to a lifetime. And that really differentiates us from our competitors. I talked about the joint coverage down there kind of at the bottom as I was describing the lifetime protection, but we've got lots of funding options as well. Very flexible. All of these types of solutions, when they originally came out, were all single pay. You know, whether it was a repositioning of a portion of the portfolio or, you know, taking a single pay out of savings or some other vessel. And that kind of precluded a lot of people from using some of these asset-based type solutions. Over our 37-year history, we have recognized that not everybody has a single premium to do. And so therefore we've come up with a lot of different strategies. We've got, yes, the single premiums, but we've got a 5 pay, a 10 pay, a 20 pay, a pay to age 95, which is really our annual pay. And all of those can be done on a monthly basis as well. So lots of flexibility when it comes to working with your clients and how they may want to fund their ultimate plan. Now, people, we are based in Indianapolis, Indiana. Our home office is. I happen to reside in Omaha, Nebraska. I think that's part of the reason they gave me the northern states. Anyway, that being said, there's more than 30 of us around the country. And so we've got 17 spread around all of the country that are dedicated more towards working with you one-on-ones, if that's what is needed. So we call them our regional sales directors, and they are really working with the, you know, any of the agents, the advisors at that street level, and can really help with anything that you're doing with consumer seminars, you know, point of sale help, you know, working if you've got an agency or just want some one-on-one training, they can do all of that sort of thing as well. But then, of course, Lynn mentioned myself and my internal Adam Frechette, and we are also support here. So one of the things that OneAmerica really wants to do is be educators and really provide the support that you are looking for in whatever aspect you are looking for. And then early on, I talked about claims, and we've got a claims benefit concierge, which I'm going to talk about a little bit further in this presentation as well. But we get a ton of great feedback around this because, quite honestly, when you're selling the promise from OneAmerica to your client for any extended care solution, you know, it's the claims really, it's where the rubber meets the road, right? It's the claims process that's there. And while many of our competitors have shipped their claims across to another country, you know, across oceans or whatever the case may be, ours are all still in Indianapolis. There are nurses right there in the home office, and they are one dedicated person for the life of that claim. So ton of great feedback about that. I'll talk more about that here in just a minute. But ponder this. Look, I've known of GoldenCare for years and years and years. A previous carrier that I worked with worked very closely with GoldenCare on some proprietary products, and still do. So I've known of GoldenCare for years and years and years. I just didn't work with them directly. So I know that, you know, any of you that are on this presentation today know really what long-term care is, but, you know, this is still a great question to always think about. If you say the words long-term care, what's the first thing you think of? Obviously, it's, you know, it's nursing home, or at least that's what most consumers would think, right? So planning, though, is in our DNA, all of us collectively. So instead of using long-term care, and you probably already made these changes to your vernacular, and I still interchange them, but, you know, extended care planning is a good way to really look at that with the clientele that you're talking to, because that takes that nursing home picture out of their head, and they understand that it's a planning aspect. So extended care planning is always something that you can change in that vernacular. So there's a couple pieces that I wanted to do some follow-ups with, and I know Lynn and all the folks there at GoldenCare will send this out to you after this presentation. And one of the things that we've got here at OneAmerica is this great little piece here called Plan for Care. And largely this can be used in a lot of different ways. There's some great information that you're asking your clients. You know, sometimes you can send this directly to them to have them fill it out, and it gives you some very good information. And, you know, if we look at the second page of that there at the very top, it says, you know, if you were going to need some income for any of those LTC expenditures, you know, which asset would you want to use first? And I think that that really helps the client start thinking about this more as a planning aspect, right? They have to now think about and write down which asset they're going to attack first or use first for any income needs for extended care planning. So that really gets them on that kind of planning mindset, but it also gives you some opportunities to work with their children there at the bottom. You know, it certainly lists some of the people and names that they want to be contacted and be a part of the solution. You know, I didn't even talk about the first page. There's some great questions there that really come from the CLTC designation, if you will. So again, I believe most of you know this extended care planning aspect, but I just thought that I would offer up this great little plan of care piece for you as well. All right, so I told you we were going to talk annuities. You know, we have two chassis, but today we're really focusing on annuities as a way to put an extended care plan in place. And there's a reason why I wanted to focus on annuities, because there's an aspect of annuities, really the Pension Protection Act, that allowed for us to put a extended care plan in place very simply. And again, like I said, no premiums, no surprises. So what am I talking about? Well, there's really two phases of annuities, much like a financial plan. You know, there's the growth portion, but really in annuities, right, you're accumulating. You start many times with these annuities as a basis is what they call it, but that's the amount of after-tax money that you put into the annuity in and of itself. Well, the growth over that time span is all tax deferred. So no taxation on that. You use after-tax dollars to put an annuity in place. All the growth is tax deferred. These are called non-qualified annuities. So what I'm talking about today is a non-qualified annuity, and that's really what works with the Pension Protection Act. So you've got that accumulation and growth. So they may put these types of annuities in place years ago. You know, the average starting age is around 53 to start an annuity. And again, what it does is it just allows that money that they put into that annuity to grow over the years, income tax free, or at least tax deferred, if you will. So then what happens is when we get to the second phase, it would be payout or distributions of those monies. Now, many times when we're looking at these non-qualified annuities, somebody put it in to say, I'm going to need this probably for some income later in my retirement years. Many of them, though, are also saving in qualified funds, you know, their IRAs or 401ks or whatever the case may be. So many times what happens, they started this annuity thinking that they were going to need it for income, but their qualified scenarios, their funds have grown so much that they really don't need these non-qualified annuities for any type of income purposes. Well, here's the problem with that. All of that growth in that first phase of the annuity is all tax deferred, meaning when they start taking distributions or payouts from that annuity, tax is going to be taken out first. So all of the growth, it's basically what they call LIFO. So last in, first out. So all of the interest that is growing was the last in, but that's going to be the first out, and you'll be the client will be taxed on all of those distributions. So really what happens with these clients is that they look at that and they say, well, that's actually a tax liability, and I really don't want to touch that annuity now. It worked exactly the way I wanted to in the growth phase, but now that I've got to start taking distributions, oh my gosh, that might push me, you know, might affect my IRMA, my Medicare premiums, that sort of thing. So they start to look at these as really a tax liability. So a couple facts and figures that I wanted to share with you before I get into the Pension Protection Act and why we really have this presentation today. You know, the oldest boomer in 2024 is age 78. And here's the very interesting fact. January 1st of 2026, so just next year, less than, the first boomer will be turning 80. Why is that significant? I think most of you on this presentation know today that the average need of care usually starts somewhere between 80 and 85. So now I talked about the silver tsunami earlier. So with the oldest boomer turning 80 and 10,000 of those every day after that, we know that this aging population, that the silver tsunami is coming. And that's why the federal government looked back many years ago and said, we've got to do something to encourage people to plan on their own. Our state's Medicaid budgets can't support everybody going on Medicaid. So again, more on that in just a minute. But if we look at where the total annuity sales are, this is a little older here, 2023, 385 billion in annuity sales just in 2023. 2024, I think it was like 405 or 408. So this is a huge, huge marketplace. And remember, that's just the last couple of years. There are many of your clients that you work with today that have purchased annuities many years ago. So what that's done is accumulated all of this tax liability if it was on a tax deferred basis. So Gallup actually puts out a poll. I think it comes out every other year. And so there's some interesting information on why people buy annuities in the first place. And so here's why some of these non-qualified owners, how they intend to use their annuity. Well, 84% of them said, I want to use it as a financial cushion. So if either their spouse or they live beyond their life expectancy. Pretty straightforward there. They just want that backstop or that extra source of funds, if you will. 79% say they want to avoid being a financial burden to their children. I think you're going to recognize that stat pretty closely there. And then 67% said an emergency fund for any type of catastrophic illness or nursing home care. If I look at all three of those stats, really, what are they saying? They're talking about long-term care. So why did they buy that annuity? Sure, it was going to be for income possibly later in life. How do they plan to use that annuity? Really, what they're talking about is long-term care. So here's a better way of using any of those non-qualified annuities. But let's look at this slide. I really like the 4 buckets analogy here. And basically it says, you know, if you're going to need $1 of LTC expenses, which bucket are you going to take it from? Are you going to take it from your qualified bucket, the one there on the far left, the blue one? So your IRAs, your 401ks, any of that. Well, obviously you're going to pay taxes on that. And that's a very conservative number there. So you pay $1.30 for every $1 of expense you have in long-term care. Does that make a lot of sense? For most people, I would hopefully that they would say no. The green bucket, now we're talking non-qualified type of funds. And again, exactly what I'm talking about here with these annuities. They're non-qualified, they're growing tax deferred. So when they start taking those out, again, a conservative estimate here is they're going to pay $1.15 for every $1 of expense. Again, not necessarily the most tax efficient way to use that type of funds. How about just cash? Well, I'll just pay for it myself, use my cash. Well, that's a 1-for-1. Again, not the most tax efficient. There's much better way, efficient and effective use by ensuring that risk up front. And there again, we're taking a very conservative amount, looking at, you know, it's maybe 33 cents on the dollar for every dollar. So I love that stat. But really what I'm talking about here again today is more of this green bucket, if you will. So these non-qualified funds with all this embedded gain, and enter the Pension Protection Act. Now, this law was drafted or signed into legislation in August 16th of 2006. Now, it didn't become effective until January 1st of 2010. So what that says is we have had the Pension Protection Act out for more than 15 years now. Do you hear much about this in long-term care planning? Probably not. It's amazing how many folks have no idea that there is this section in the Pension Protection Act. And again, when I say Pension Protection Act, you're thinking, aren't we talking long-term care, extended care planning here? Why are we talking about pensions? Well, most of the act, yes, dealt with pension reform, but Section 844 deals specifically with annuities and long-term care and tax advantages associated with them. So this has been out for 15 years, but nobody's really looking to use these types of annuities. And again, let's remember, many of your clients already today have one or multiple in their portfolios. So why is the PPA important? Well, as I said, when somebody is going to start taking distributions out of that annuity already in their portfolio, and it's not a Pension Protection Act annuity, all of the cost basis they use with after-tax funds. So that's not taxable. But all of that embedded gain, so all of the growth through the years, so the longer they've had that annuity in place, the more growth there is, that is all going to be taxed on distributions. And so what does it say here? It's going to be taxed in numerous ways: federal tax, state tax, provisional income, Medicare premiums, IRMA, as I mentioned as well earlier. So again, that dollar is not a dollar. Whatever portion is not there, they're actually paying more to get that $1 needed of income for any of those expenses. However, if we just 1035 exchange, very simple process, just fill out an application. I'll talk about a little bit more about that here in just a minute. We're just going to exchange one annuity for a Pension Protection Act annuity. And here's what happens. Now, all of that taxable growth, all of that embedded gain in those contracts that is going to be taxable on distributions, when you 1035 exchange and move it over to a Pension Protection Act annuity, and all of our annuities here at OneAmerica are PPA annuities, then all of the money out of that annuity is going to be tax-free if used for long-term care. So this is a great solution, knowing that your clients likely already have any of these annuities in their portfolio. So I get questioned around that just a little bit as well. It's like, okay, so if we're moving it to a Pension Protection Act annuity, what are we losing here? What's my client losing? For years, what they do is they chase the rate, right? Who's ever paying, so they have a surrender charge on those, and once they get out of those surrender periods, they find out they can move that annuity, and they just chase the highest rate that's out there. So for years, they're chasing the rate. Well, unfortunately, at some point, rate's not so much that important to them. It's more that tax-efficient distribution that's more important to them. And I can ask a rhetorical question here, but what client of yours, or what American for that matter, wants to pay more taxes? I can pretty much say that answer is no, none, right? So what are they giving up by moving it over to a Pension Protection Act annuity? Well, you can see the first three lines here: tax deferred growth, account value access. Those, all of those are available in both their existing annuity and a Pension Protection Act annuity. So all of those are exactly the same. So they're not losing anything there. Here's some things that they are gaining though: tax-free income for long-term care by just simply 1035 exchanging to a Pension Protection Act annuity. We can add the spouse, and I'll get to that here in just a minute. So once they really recognize, hey, there's some great tax mitigation that I can do, why wouldn't I want to add my spouse to this, especially if she didn't have her own or he didn't have their own, whatever the case may be. If they didn't have their own annuity, of course I want to maximize the tax benefits. Let's maximize the ways that we can get that tax-free money out of this annuity. So we can add the spouse. They must be also qualify as well. They get our claims concierge. And again, many times this is what sells the whole program from the very get-go. consumers have no idea what it really takes when a claim situation certainly arises. It's a very tumultuous time for them. It's a very stressful time for them. You know, they're trying to care for their loved one, obviously recognizing there's some troubles there, but yet they have to go out and do their due diligence. And really what the claims concierge person there is there for is to really help them through that very tumultuous claims experience, especially to get it started, and let them love on their loved one, that one who is needing care. So that claims concierge is a huge benefit to them. And many times, again, that's kind of what makes that sale, or allows them certainly even more to utilize the tax-free nature of a Pension Protection Act annuity. And then, you know, I do get this question from time to time too. Well, what if they don't use that? So they move it over to a Pension Protection Act annuity, and then they don't need care. Well, there's a high likelihood they're going to, right? We've all heard the stats of 70% as Americans over 65 are going to use some form of long-term care services in their lifetime. So it's a high likelihood that they're going to, and especially if we couple that, like, well, pun intended there, a joint policy, if both are on one policy, now we take that 70% if they're both over 65, we're talking more like 91% that at least one of them is going to need care. So a high likelihood that they're going to need it. But let's just say they're one of the lucky ones that never need it, right? Well, it's going to pass on. So the remainder of that annuity account value will pass on to their named beneficiary, you know, on their death. So this still creates a legacy as well. It gives them the protection of extended care planning needs, but it also creates a legacy if they never need it. And that's what consumers really, really like. They don't want to put premiums into something that they may never use. So this is a great way to say, hey, you've got the protection if you need it. If you don't, it's going to pass on to your heirs. So again, they're really not losing anything. They're actually gaining benefits by moving it to a Pension Protection Act annuity. Well, there's a couple things that must happen in order to be a Pension Protection Act annuity. First and foremost, it must have language around the IRS 7702B, and that's really qualifications for true long-term care. All of our annuities have that classification of 7702B. And then in order to be a Pension Protection Act annuity, it must have some form of underwriting. But I told you early on, I don't want you to have any premiums or any surprises. Well, surprises many times come in the form of underwriting, correct? So here's what's great about a base-only exchange, and that's really what I'm going to focus on today. So just taking that existing Pension Protection Act, moving it over to a PPA annuity, there you do that with no premiums. You're not asking them for any extra money, right? So no premiums and no surprises. Surprises come with underwriting. So here are your knockout questions. If we just do a base-only exchange, we do our this app through our e-app process. Very simply, we are going to ask them 5 questions, but the first 4 are all we're using for underwriting purposes. So I haven't done this yet, but I've got a one-pager that Lynn and the folks from GoldenCare will be sending out to all of you that have these questions on the back side of it. It's a sales piece, so you'll know what they are. But really, the first 3 are they needing care today? So these are very simple questions to answer no to. And if they can answer no to all 4 of these questions, we're going to instantly approve them. Again, no surprises, because you can give them the questions up front. And you can say, Mr. and Mrs. Client, can you truly say no to all of these questions? So again, let's review these questions. First 3, all are they needing care today? Do you currently use any kind of mechanical device? Wheelchair, walker, quad cane, oxygen, motorized scooter, things of that nature, right? Pretty straightforward. You can understand that off the top. They can answer no to that. We'll move on to the next question. Do they currently need any help with any of their activities of daily living? I know you guys know what that is, so I don't necessarily need to read that. They answer no to that question. We move on to the third question. Do you currently have or have ever been diagnosed with the biggies, right? Alzheimer's, dementia, muscular dystrophy, multiple sclerosis, Parkinson's, memory loss, things of that nature. So, right, like I said, the first three, are they receiving care today, essentially? Answer no to that, we move on to the fourth question. Fourth question is, do they have AIDS or AIDS-related disorders? Now, you see HIV there, that is no longer a knockout. We just have to refile the application, and that takes a little bit of time with the states. So just know HIV is not a knockout, even though it's still listed there. But if they can answer no to AIDS or AIDS-related disorders, we'll instantly approve them. And even if we are going to ask this fifth question, are they currently or have they ever received Social Security disability income? But whether they answer yes or no to that, it doesn't matter. If they can answer no to those four questions right up front, they're going to be instantly approved. And again, if we're 1035 exchanging, no new premiums that you're asking for, no surprises. You've given them the questions up front. We don't do any behind the scenes script check, no MIB check, none of that happens. So it's an instant approval, 4 knockout questions and a 1035 exchange. Very, very simple process. Now, I mentioned this earlier, and I really like to hit on this and make sure that you understand exactly what it means. So when you're 1035 exchanging, probably many of you have done this before, but what it must be is a like for like. So the NAIC set some guidelines around this, or rules, if you will, that it must be a like for like exchange, meaning most of these, or many of these, I should say, non-qualified annuities are individually owned. So what we do is we 1035 exchange, and it's still individually owned. So no changes there. But because the consumers and hopefully you then as their advisor or agent are explaining all the tax benefits that are there by just doing this simple 1035 exchange, they recognize, well, gosh, I own this one, but my spouse doesn't. Can I add them to my policy? Well, here's the great thing. We've got this eligible person provision. So again, we 1035 exchange, still singly owned. Now, it must be their spouse. But when we do that 1035 exchange, here's what happens. We can add that spouse so they can have joint access to the cash value in that annuity. So really maximizing all of the tax efficiencies, tax benefits from a PPA annuity. Now, if it happened to be jointly owned, we just do a 1035 exchange and it's still jointly owned. But this eligible person provision is really a great way to put 2 people on the same policy to maximize those tax efficiencies. All right, quickly, I want to do a quick case study and talk about really where I suggest. Now, we've got 3 annuities in our portfolio, but when I'm talking about this base only exchange, meaning not adding our COB rider, because this is the easiest way to really put in an extended care plan in place. Again, 1035 exchange, and no surprises because you can ask them the questions up front. But I suggest always using our indexed annuity care solution. So here's what I've done is just show you here a 77-year-old female, and we utilized an existing annuity that she had. Let's call it, she took it out for $50,000 years ago, now had grown to $200,000, and we're just going to exchange that because she wants to take advantages of the taxation benefits. So this is what's showing in growth after year 1. So again, we did a $200,000 exchange, very simply, no new premiums, just exchanging one policy for another. It created a monthly benefit amount there of $88.48. So what a great amount there to have available for her. After year 1 of growth there, you can see that the account value has already grown. It was $200,000 that came over. Now it's already $212,000 in the total LTC value. The account value itself is a little less. We're always giving a little bit more as in the long-term care insurance company. So the account value has now grown to 210, 251. So these will continue to grow as well. So even when you put these in place, yes, you're going to allow for tax-free distribution for long-term care of the previous growth, but even any future growth, the longer they have these in place as well. Now, I said she's 77, right? If she can already qualify, it's a high likelihood she may live till 87. So we also wanted to show what the 10-year value of growth was as well. So her monthly amount after 10 years of growth, now at age 87, if that's when she started to go on claim, would be $16,476 per month. So what an excellent benefit. And watch the growth here. The total account value, again, remember 200,000 came over, but after that 10 years of growth, the total account value, or the death benefit, if you will, if they didn't need it, is 359,470. Great growth in this solution. And then the total LTC value, nearly 400,000. Now, I do want to explain where we get this monthly benefit amount from, right? The indexed solution will stretch whatever amount of money, and really what we're taking here is the total LTC value out over 2 years, so a 24-month period. However, let's just say that, you know, in year 10 after growth here, she's only needing $12,000 worth of care. Well, we'll only reimburse for the $12,000. The extra amount over and above that, the 446, so 4,446, stays in that pool. It elongates how long that's available for them. But again, why I think this is so valuable is just the tax-free distribution for long-term care. And many of your clients already have them in their portfolio. I love this little pink sticky note here, instant approval. And again, you can know that up front, so there's no surprises. Guaranteed step up for LTC, and that's why we're seeing the LTC total value actually higher than the account value, is because we're actually giving them, it's almost acts like inflation, like a 1% inflation each of those years. So this is a great solution here. Now, I talked about this early on as well, our claims benefit concierge. So help is only one phone call away. Again, these are all nurses in Indianapolis. They're at the home office, not across an ocean for cheaper claims mitigation. You don't have to deal with language barriers, anything of that nature. But it really is going to help that family through starting that claims process and allowing the family to do what they do best, and that is love the one who is needing care. So this claims concierge process is very simple. So if we look at it, here's what the claimants do, right? The family or whatever. They either call, there's an 800 number that we have, starts with one call, or they can go to our website and go online and initiate that claims process. They'll sign and submit all the forms that we need, and they can email them, fax them, mail them, snail mail, or fill them out all online. I'm going to move over before that last one to what OneAmerica does there. We've got that dedicated care benefit concierge, and they will handle that claim and assist them from day one of that policy. And they'll be the same claims concierge person for the life of that claim. So there's no more calling in and having to re-explain, hey, well, here's what we've done, or here's what's going on, here's what we're looking. They know all that. They're the claims concierge for that claim process. And the claim benefit concierge will do all of these things: answer questions and help with the paperwork, contact doctors and care providers, review policy information, determine coverage eligibility, contact the providers to finalize a lot of the details as well. So getting that final plan in place. So the care benefit concierge will take all of that. Then if we move back to the claimant side, the family, they can focus their love and attention as only they can give. So really help that person that is needing those claim situations in a very straightforward and loving process. Now, I want to talk about the advantages of doing this base-only strategy, right? So 1035 existing annuities out there into a PPA eligible. Well, what are the advantages? First and foremost, all of the benefits are tax-free if used for long-term care. So all of that embedded gain, any of the future growth will all be tax-free if used for long-term care. We can add the spouse. What a great way to maximize the tax efficiency of this. We have the family access to our care benefit concierge. So that's great. Again, instant approval. I talked about this. As long as we do this through our e-app, we're doing a base-only exchange from one annuity to our PPA annuity. It's going to be instant approval if they can answer no to those first 4 knockout questions. We'll go all the way up to $1 million. So there's a lot of these annuities out there that are 500,000, 750, $1 million. I've seen some for 3 million. So we'll take even a partial exchange up to $1 million for these types of solutions. Issue ages all the way up to age 85, and actually 86 and 87 with home office approval. Now, I've never been turned down on an 86 or 87-year-old, but we just need to know that and kind of let the people internally know that up front. So really think of your clients as they stand today. I would say you can do a book review and say, look for your clients that are 70 to age 87. Very simply, do a book review of your clients, look for those ages. And if you don't know if they have annuities, it behooves a quick call to them. You've already got that relationship with them and say, you know, really, I've been working with some of my clients lately on a tax mitigation strategy. Do you happen to have any annuities in your portfolio? Let them answer the question. If they say yes, say, can we do a quick review of those? Because again, I've been really helping some of my clients save a lot of money on taxes by just doing a simple 1035 exchange, which is exchanging one annuity for a different type of annuity. So very easy process to do. And again, if you're doing that, there's no new premiums that you're asking for, and there's no surprises because you can give them those 4 knockout questions up front, and you'll have no surprises on the back end. If they can truly answer no to those 4 questions, we're going to instantly issue them instant approval through our e-app. So really love this solution. And I wanted to do one other thing. I wanted to give you, take out your phones if you would, really quickly, just in case you would like some more resources. Again, I've already sent Lynn and the folks there at GoldenCare a number of pieces that she's going to use to send out to you as a follow-up, if you will. But if you would like to have some more resources, if you will, I'm not sending this presentation out because if you scan that QR code, it's going to take you to this Annuity Care landing page, and you can listen to a live recording of this same presentation or very similar to the same presentation, but it's from a different one of my colleagues. So sometimes it's beneficial to hear the same message from 2 different people. Maybe you'll pick up on some of their language a little bit different. Plus, there's a lot of other information on this Annuity Care landing page that you can access as well. So again, take out your phones, scan that QR code, and then hopefully I've given you enough time to do that. So with that, what I'm going to do is I'm going to open it up for questions, and I tell you what I'm going to do. We're going to open it up for questions, Lynn, but I am going to back up here and just leave this QR code up there in case somebody hasn't gotten it yet.
And that's a good idea. I do already have somebody that submitted a question, and you may have already answered it, but can you 1035 exchange a qualified annuity into a PPA annuity?
So that is a great question. I did not tackle that. So when we're talking about the Pension Protection Act, one of the things that it said is that we could exchange certain types of annuities. Non-qualified annuities were those certain types. They probably should have just wrote that in there. So any qualified annuity cannot be exchanged for a PPA annuity. We have a great solution on our life chassis that we can use any of those qualified annuities and put it into that solution on our life chassis. However, that comes with a little more underwriting. So great question. We can't use qualified annuities for the PPA exchange. but we do have some great solutions with a little extra underwriting.
Okay. And we do have another. This one refers to the scenario, the example that you were just reviewing with the 77-year-old female, I believe. In your scenario, how many years slash months of benefits are available?
Yep, that is a great question. You may not have heard me say it or picked up on it when I went through that. So the indexed annuity care solution as a base annuity will pay out over a 24-month period, right? So 2 years. But remember, because of the growth in these types of solutions, I look at if a client of yours has at least 7 years before they're going to actually access it. I mean, of course, none of us really know when that's going to happen. But if you're looking at them and you know that they're going to have at least 7-10 years before they're probably going to access that, the index solution, because you're choosing indices to grow that money versus the S&P 500, we've got 5 choices there. It grows at such a healthy amount. It illustrates so very well, even in the guaranteed section, which is not typically what's going to happen. So the typical is going to be even more than that. So the growth there, anything over and above their monthly amount stays in that pool, just elongates that plan. But the base plan itself pays out over a 24-month period. So great question.
Okay. Another question we have submitted, are there product enhancements coming for your plan soon? Maybe peeking
So
behind the veil.
yeah, I think you're right. Can I give away some industry secrets, huh? Well, I will say this. Our actuaries today are actually looking at our annuity care portfolio in and of itself. On our asset care, which is our life chassis, we just did some great enhancements, and that took about a year's process to really do that and file and do all of the things that are needed. That rolled out in October of 2024, those enhancements. Right now, they are looking at our annuity chassis. We've got 3 solutions on the chassis as it stands today. But yes, we are going to make it much more simpler. If there's one thing that I have to apologize for here at OneAmerica, is that we have really tried to be everything to every client out there and have solutions for that. Well, the problem with that is it comes with a lot of complexity. So we've got a lot of different solutions to choose from. So we're really trying to now work with our annuity suite and really simplify it as well. So yes, there will be. I just don't know the end date of that. So great question.
Well, and
We'll
I think even estimating a time frame is probably not the best idea, because we never know what the states, departments of insurance and timing, it all depends.
Yep, very true. Hopefully
All
by the end
right.
of the year, probably more sometime early next year. But again, this solution isn't going away. This is here from day one.
Good deal. We have another question. If no LTC benefits are needed, does client have access to assets for whatever they may need?
Yes, that's a great question. And I didn't really touch on that. So I'm glad you asked that follow-up question. So even by moving it to a PPA annuity, like all of ours are, they always had those 10% free withdrawals, like any other structured annuity out there. So if they just needed to access for cash for some reason or another, they can access those every year 10% free withdrawals out of that account value. Now, typically, when that's their long-term care play, I will say this, most of them find other areas for those premiums, because when you're taking that out of the account value, you're also reducing dollar for dollar your LTC benefit amounts. So that's why I say typically when these are put in place, they find other areas that they can access cash from. But yes, they can use that for any other purposes if they'd like, if they know that they're not going to need that long-term care services. And remember, any of the amount that is not used will pass on to their named beneficiaries.
All right. Let me scroll down. Okay, I think we've covered all of the questions that have, someone says thank you for
Oh,
answering an earlier question. Good deal.
can I add one more
Any,
thing, Len?
sure, absolutely.
Yeah. So, hopefully in the description of this, I to me, I've spent 23 years of my career in long-term care. So, on the traditional side, now on the asset-based side, and quite honestly, to me, this seems like the first place that you should always go to start some sort of long-term care or extended care plan with your clients. Because if they've already got these annuities, why not make them a tax efficient distribution and put that in place? Whether they've got a long-term care plan in place or not, this is a great stacking strategy. We don't coordinate benefits with any other policies out there. So they can access two different policies. So even if they've got a long-term care plan in place, you've already worked with them on that. This is still a great avenue to talk to them about, because really it's a tax mitigation strategy. And that, every client, again, will appreciate you helping them pay less taxes. So just wanted to throw a couple of those things out there as well. So you can stack, you can combine them with other types of plans, short-term care plans that, certainly GoldenCare offer as well. So, these can all be kind of paired together, if you will.
All right. Now, you did say that you're not going to be sharing the presentation slides. With the QR code, I believe I should be able to share that link directly out to that resources page. You said there's
Yeah, I can.
a
Yeah,
recorded video of this.
here's what I'll do. I will. I'll make a PDF copy of this particular presentation. The one that is on that resources page is, very similar, but it's maybe slightly different, maybe one or two different slides, if you will. But again, it's just, what's nice is that you're going to hear it from a different person's standpoint or viewpoint, or
Yes, we do that quite often with our own presentations,
yep,
our own training on various things. So it is, sometimes you pick up on certain details or something resonates a little more clearly with you, or it's easier to understand just by someone phrasing it a little differently. So absolutely.
yep, that's great. So yeah, if so, I will share so we can get that QR code out, Lynn.
Perfect. There was one more question.
Awesome.
Is the fact finder on the resources page, or are you emailing that out? I actually have that, Mark, and that's one of the pieces I'll link to in the follow-up email. So be on the lookout for that. I'm not sure if it'll be sent out yet today. If not, it'll be sent out tomorrow. So just be on the lookout for that follow-up email. Okay. Brent, I really appreciate you taking the time. When you first introduced the strategy to me, there was just such a moment where there's quite a bit of opportunity here, and we're all about extended care. Here at GoldenCare, we've adopted that the terminology. Long-term care just has some negative connotations, even amongst some of the agents newer in the business. Extended care really does soften that, and it doesn't come with as many preconceived notions, mostly negative. So um, I do think this is a really good strategy to be reaching out to existing clients. We're all about cross-selling and really building those client relationships. And this is just one more way you can be helping your clients, providing value, coming back and offering them another service or just another strategy in ways they can save money, ways they can, have additional tax dollars saved. And all of that may translate into sharing their own story with friends and their colleagues. So, um, absolutely. I feel like this is one of the best ways to start that conversation, even with older, well, with existing clients especially. So
Yeah.
Brent, thank you so much for taking the time. I know we've gone just a little bit longer than usual, but again, we were answering questions as well. Um, I didn't see the specific contact information, Brent, for you and Adam, but that's okay. I'll put that in the follow-up email as well. Again, everyone, feel free to reach out to GoldenCare if you have any questions. If you really have some super detailed, wanting to review some really detailed information or a specific case, we're more than happy to help. But I don't want to speak for everyone else here at GoldenCare, but I know I'm not the expert in annuities, and I know Brent and Adam, and in fact, all of their team, they do this all day, every day. So they'd be able to give you quite a bit more insight and help with those specific cases. But again, I'll include their contact information in the email. And any of you, if you haven't been to GoldenCare Agent yet, that is our agent-facing website, and it has a ton of different resources. The recording of today's presentation will eventually find its way on there, and you'll find a whole library of other pre-recorded training videos. Go out there and check it out when you have a moment, especially if you haven't already. Thank you, everyone, for taking time out of your day. Thank you, Brent, again, for coming on as our special guest speaker. I hope everybody has a great rest of their day and a great rest of their week.
Wonderful. Thank you, Lynn. Thank you, GoldenCare. And thank you all of those who came today.
GoldenCare is always here to serve you with new tools, new products, new ideas, and new innovations, and always the best support in the business to help you succeed. So give us a call at 800-842-7799 and check out our website at www.goldencareagent.com.